kind of not doing much in this market right now, even though we have a government shutdown that has effectively been averted. We are asking ourselves, what do you mean? Why are we only rallying just a little bit today? Well, we're going to walk a little bit through that. We're also going to talk about today's top headline and the most useless headline that we have today. This is very important because these types of headlines are the things that will impact your money if you are not careful. We'll talk about our daily tune-up, and today's core thing is around two elements. One, building a good watch list, and secondly, reversion on Fridays. All right, let's dive into it. Good morning, everybody. Hi, Bobby. Hi, Gil FL. Bill. Brett's. Oh, that's Brett's in there. All right. Randy, good morning, everybody. Everybody having a good morning? Let me know. And we are going to dive into this. So, all right, it's Friday. We're coming off an extreme bottom right now. I'm going to walk you through that when we do the tune-up. But what I mean is there is zero buying pressure in this market right now. Zero. So everyone who's sitting here wondering, why has there been a big turnaround all of a sudden? You know, usually when we hit these oversold levels, we get at least a squeeze, right? Well, we're not seeing anything yet, largely because people are waiting for the upcoming Fed meeting, which kicks off on Tuesday. And why is it relevant? Well, we have not had any clues about what's going to happen with the Federal Reserve and with interest rates. All we have at this moment is speculation. Now, Jerome Powell is going to speak, or try to. He will probably just make a very well-crafted statement in which he tells us nothing, and then the market will react in a way that it has over and over and over again. 235 on Friday, on Wednesday, everybody pay very close attention to 235 on Wednesday, because 9 out of, I guess, the last 12, we have had a squeeze right at 235 to 237. And my recommendation on everybody is to be here with us on Wednesday as we trade this live, talk about this live, because all it is price action that happens. And we have seen a significant squeeze transpire within the first 5 to 7 minutes of Powell speaking, and I would not be shocked if it happens again, given the fact that we are coming off of the extreme bottom where we are. Now, why are we talking about this concept here, this headline that I argue is so important? This comes from QuantSeeker, trading the Fed. The pre-FOMC drift is alive and well. Okay, I want you to write this down. The pre-FOMC drift. What is it? This goes back to a 1990s report that was written, and effectively what it means it is an anomaly. It is a phenomenon. There is no explanation for this, but the drift refers to a phenomenon in the equity markets where stock markets tend to rise hours and days ahead of the Fed meeting. Does not matter what is going on in the markets. Does not matter if there is war, if there are tariffs, whatever it is, the markets tend to drift higher into the announcement of what the Fed is going to do. Now, we don't even have an announcement expected, right? We're not expecting that the central bank is going to cut rates. And if we go to FedWatch and pay very close attention to what's happening over there, the odds are changing for a interest rate cut, but they're not changing until we get out to the June meeting, right? So right now, the odds of a Fed cut on Wednesday, according to the FedWatch tool, which is a measurement of futures, we are at 3% odds of a cut. Out to May, we're out to 30, which is sizable when you compare it to where we were about a week and a half ago. We were a month ago, where we were at 18%. We are now at 30. But if you go out to June, markets have largely priced in a cut by this point. We're above 56% cut of a 25 basis point cut and about a 20% chance of a 50 basis point cut, which would be very, very sizable. And once again, a little bit of concerns that we would be a little bit behind the curve in terms of what's happening with our economy and the ongoing pressures that we're seeing in this market. But don't be shocked, despite all of this uncertainty, if we do follow this phenomenon. And this phenomenon was very, very popular in the 1990s, and there's a lot of focus and belief that it has kind of dissipated over the years, or it's been arbitraged, but it still is in the back of the minds of a lot of investors, and it becomes behavioral as a result of that. It's a systemic bias toward optimism ahead of the central bank announcement. And this is one of the things that is very important to remember, that behavioral elements come back into play, every day in the markets. But when you have these big events or these big scenarios, short covering will happen because people may be shorting this market into the ground at the moment, into oversold levels. They may cover their positions, or you might just see some people looking at the current state of the market and saying, okay, I'm going to go back in. I'm going to dive back in. I'm going to push across the table. I'm a compulsive gambler, whatever it is that you want to see. So some people may be very tactical and some people may just be extraordinarily speculative. But historically, this behavioral element is very, very important. Now, there is the perception that, yeah, maybe some people have access to the information ahead of time. There's not a lot of conclusive evidence for that. And as a result, again, investors may be positioning themselves and betting heavily on the fact that there is only a 3% chance of an interest rate cut, but maybe the odds are actually somewhere around 10%. Maybe they're somewhere around 15%. And maybe it actually happens. Maybe the market's just absolutely ripped because Powell surprises. There's still a very low probability of that because we would have seen some level of at least a hint somewhere in the minutes, somewhere in the speeches, somewhere. Because if they do come out and they do suddenly say, oh, God, we got to cut, well, that's not horribly bullish in the long term. That's actually a concern because it effectively acts like an emergency interest rate cut in a meeting. So once again, the market's positioning this in very, very low, but some people will bet that Powell's going to make the surprise. I'm not going to get in the middle of that one, though. This is an extremely unhelpful headline this morning, and this is from DealBook. Oh, the New York Times. Shocking. Can't believe they're going to absolutely screw this one up. Tesla tariffs and a market meltdown. Ooh, I see two opportunities in a headline like this. The first is Tesla, which is getting its head kicked in and has been one of the worst performing stocks of the last month and a half. Now, I've walked you through this already, but let's do a quick reminder. When we have the signal that we were following around around the S&P 500, we are focusing heavily on moves over the 20-day moving average. And a very simple technical component here, this is the TSLS, which is a bearish ETF for Tesla. When people are betting against Tesla and it gets into a momentum environment, we had all of these oscillators, all of these indicators that we are using. MACD, we want to see positive. Well, it's been running positive and running relatively hot since December, but let's ignore that. Let's focus on the RSI, Relative Strength Index, price momentum, Money Flow Index, price and volume momentum, and the ADX, Average Directional Trend Analysis. Well, as you can see, the ADX flips, gets into positive, starts to move heavy positive territory back here, and that is, what date is that? February 4th. Well, as you could see, the TSLS moved over the 20-day moving average right here on February 3rd. And what has happened since has been an absolute destruction. And as we can recall, we look at the current status of Tesla, and in hindsight, we say to ourselves, God, how did we miss this? How did we miss the fact that Europe is completely angry at Elon Musk, that sales are falling in Europe? In hindsight, we say to ourselves, God, how did we miss this trade? We should have jumped on this trade. The reality is, and this is one of the most important things that I can stress when it comes to the behavioral elements of trading and finance. The trade already happened. It already happened. So when you see a headline like this encourages you or makes you think, I better keep jumping on the Tesla, anti-Tesla bandwagon, when in reality, Tesla's actually been coming off of a bottom. Tesla's actually up in recent days. Doesn't look like it from that longer term chart, but here's our bottom back here on the 220. Doesn't mean that I necessarily am eager to short Tesla or be long Tesla. My point is the trade already happened. It already happened. And the bulk of the gains that could be realized shorting Tesla happened back here at the 20-day moving average with the positive switch on the ADX for the TSLS and the improving momentum over 50 readings on the RSI and the MFI. It already happened. So you're late. And what is happening in this environment, this is what I keep stressing. There are people who are constantly talking their book in this market. They're going to go on to CNBC and they're going to say, I'm net short X. Well, they've been net short X for a month and a half, and they would love nothing more than to sell their puts to you. And you see this all the time. People who are long something, they're going to go on, they're going to talk their book. They're getting out. So be very cautious in this environment, because what's happening right now is this becomes the headline story. And when the headline story really picks up, and when you start to see people coming in and saying, oh my gosh, Tesla's doomed, or you start to see this pop up on the headlines of the New York Times or the headlines of Barron's, the trade's over. The trade is over. The bulk of it is over. And what you're going to do now is you're going to wait a little bit of a period of time, keep this on a watch list, and then just wait until you start to see the price action again. And I stress the importance. I am very, very, I don't want to say I'm risk adverse. I'm just cautious. I like to be at the front of the line. I don't like to be in the middle of it. I don't want to be chasing anything. So I'm not going to chase Tesla. I'm going to ignore it. And when it comes to this current environment, one of the key things that we are talking about is this idea, market meltdown. Everything seems blood red in the streets. It's because it is, but there is an important element to this. We have no buying pressure. I have not seen this since late November 2021. And what happened at that exact moment, you have to recall, we go back to COVID. We go back to March 2020. We have this monstrous sell-off. It is a once-in-a-century pandemic. And you have a we had a deviation. I can't even remember what it was. It's somewhere in like the 60,000 years figure. But the S&P 500 falls, and we have no buying pressure. And then the man who, once again, people talking their book, goes on CNBC and says hell is coming. The market bottoms out on March 25th. The day prior, or somewhere within the next 24 hours, 60 minutes, Neil Kashkari of the Minneapolis Federal Reserve comes in and says, we have unlimited money. We're just going to push a button, and here comes all this money, and it falls out of the sky. Ackman covers, and the market just takes off. Momentum turns positive somewhere around the 4th, 5th, 6th, 7th of April, and then we're off to the races. That rally ran until November 2021, which coincided with concerns around new inflation, which coincided with the Federal Reserve changing its guidance and saying we need to start this process of tightening, of raising interest rates and running assets off of our balance sheet. The market did not like that because it had been on a sugar high for the better part of 2 years. Now, as we look at this right now, one of the big things that we are looking at, it is the idea here that the market is kind of almost pricing in tightening, or at least the impact of tightening. Well, what is that? Yesterday, I explained that a ton of stimulus that came in from the Treasury Department and the Fed in the last year, estimated by Michael Howe at $5.7 trillion, is disappearing. And now the market doesn't like that. The market is looking for some level of accommodation. It's looking for rate cuts. It may not get that. That said, when we hit these extreme oversold territory on RSI and MFI, as you can see, 30 on the RSI is considered oversold. That is a price oscillator. And the MFI is price and volume. Oversold is at 20. Typically, when we see both of them down these level at the daily level and on the daily screens, and we see the S&P 500 in this extreme breakdown territory, that is usually a short-term bottom, if not the bottom of the entire situation. That said, we are not seeing a significant amount of insider buying at the moment. We aren't seeing extreme insider buying. The blue line is dollar for dollar buying to selling over right now in this chart the last 6 to 7 months. The insider buying pressure was extremely high at the end of December. It's nowhere near anywhere that I would anticipate that this would signal that the insiders are ready to step in and say the worst is over. And again, as I have noted, insiders call the bottom of every single crisis over and over and over again, going back to 2008. All right, so good morning to the 9 o'clock people coming in. I hope everybody's having a good day. Brent, T-Con, good to see you guys. Brett's in there. So what are we seeking in this environment? Well, obviously, we may see that drift. I anticipate we're going to see a drift, and I would highly recommend that you are with us next week on Wednesday, because this Fed meeting, I don't like to say that it's the most important Fed meeting ever, because every meeting becomes the most important Fed meeting ever, right? We keep being told that by CNBC, and they're going to have big flashy headlines. What's really important about this Fed meeting is it's going to actually give us some clues in the ways that Powell lays out effectively the next 4 to 6 months. Guidance in this environment is going to be more important than the actual rate decision itself, because people are concerned about recession, they're concerned about tariffs, and what they want to know is at what point does the central bank actually have to step in and effectively flip from quantitative tightening. Now, as I noted, we have been easing despite the fact that we have been told we are tightening. So let's put those two things together and just say that we have been supporting the economy for the last 16 months, and that was what we walked through yesterday in the GDP charts that showed that there was at least some level of manipulation in the economy and actions by selling all of those short-term bills into the market by Yellen, which ultimately led to significant increases in liquidity in the system, which led to an increase in credit, which led to an increase in risk, which led to us hitting new S&P 500 all-time highs. That is being deflated right now, and the market sees it. What is happening, unfortunately, is everybody keeps saying that this is just about tariffs. It's not just about tariffs, and it's not just about Europe. This is a market that relies on capital, and the cheap capital, the capital that we have relied on for every single bubble that has been transpiring going all the way back to 1971, but really since 2008, well, that air is leaving. We are moving into the back end of this cycle, and we're already seeing consumer defensives starting to get a bid up. The XLP had moved from around 75 up to as high as 83. That is the consumer staples. That is one place where money is rotating. We're also going to be looking at insurance. So what I want to see here, and as I start to put together lists and I think to myself, okay, we're at this short-term bottom. What am I actually going to be looking to buy right now? For me, we are still at a 1-to-7 ratio, buying to selling. So selling is still exceeding buying, but you got to remember that selling is always transpiring. Executives are paid in stock. They are paid in options. They are going to take money off the table. They may sell for any reason, but right here, as Peter Lynch says, insiders might sell their shares for any number of reasons, but they buy for the one reason only. They think the price will rise. What I am looking for in this environment, and we will have a list of these because I have to spend some time over the weekend looking at it, I want to find companies that meet certain criteria. 1, I want them to be defensive. 2, I want them to be in the insurance space. And 3, I want them to produce income, because money is going to be moving to bonds. Money is going to be moving to closed-end funds that have credit exposure. Money is going to move to MLPs. Now, you know that we like Energy Transfer. The ticker is ET. It's gotten beaten up a little bit because of oil prices, but that is kind of inevitable. You have Enterprise Product Partners, EPD, and ET. Think the extraterrestrial. Those are two pipeline companies that we love out of Texas, and oil moving from the Permian Basin to the PADD 3 refineries and to the ships that will be taking it out of this country. That said, we want to be looking for other forms of income too. So I want to see executives who are stepping in and buying companies that pay very solid dividends, and there's a reason for this. as you can see, we go back through, this is ET right here. There has not been a significant amount of insider buying on Energy Transfer since roughly 2001 to 2024. This was the largest, one of the largest insider buying campaigns that we have seen in about 15 years, and it was largely conducted by their executive chairman. So despite all of the problems that we had in 2022 with sinking equity markets, this guy, Warren, was stepping in and buying his stock in droves. And what is comforting about that is that he foresees long-term growth for his business, but also this is a company that pays a significant amount of capital back to its investors through distributions. Now, an MLP is different than other companies because they bypass the corporate income tax levels and they distribute portions of the capital directly to the shareholders, which means that the shareholder has to file a K-1, which I will tell you right now is a pain if you don't like paperwork. But that said, they pay higher than average distributions, so 7.5% is attractive in this environment. You just have to be willing to do a little bit more tax paperwork. On top of that, though, if we see that there are companies, and Dorchester Minerals was a good example of this. DMLP is the ticker, also an MLP. I'm going to warn you, but this has been a company that has seen large amounts of insider buying by their executives, by, for example, the CEO coming in and buying the stock recently, about $100,000 in shares. CEO, multiple purchases for multiple months. DMLP is exactly what it says it is. It's an MLP. This stock is trading at $29. This stock has an 11% dividend. Now, I have to dig deeper into the business itself for a deeper understanding of the sustainability of its business and what their threats and risks are. But when the CEO is buying the stock in the droves that he is, $500,000 here, the CFO at $105,000 back in November, at 32, by the way, while the stock is currently at 29, it's suggesting to me that yield is safe. It's suggesting to me that they have confidence in their company. Now, I'm going to go back and I'm going to look at their ratios and I'm going to make sure that they can cover it. I'll look at those specific things. But as I'm building a watch list and I'm building the stocks that I want to start to investigate, that is at the top of the list in this environment. Because if I'm going to be weathering this storm, I want to be in names that are going to be paying strong distributions that I can dividend reinvest. So I might be buying this stock. It has a 10% dividend, which effectively means if I buy it today, I'm going to generate about $2.90 annually from the stock that's trading at $29.50. Okay, well, the stock might go down to 25 bucks. No doubt about that. There's market risk. That said, that distribution that I am going to come in is effectively constant from where I bought it. So if I'm getting $2.90, I am reinvesting it back into the stock at $25. And then because I have confidence in the company over the long term, if once we get past whatever this situation is and we see appreciation in the company, we see improvements in return on invested capital, we see improvements in its efficiency, and let's say this stock gets back to 35. Well, I've been buying with the distributions through stock reinvestment, this stock down at 25. So I'm making money. I'm reinvesting at lower levels. I'm riding out this storm, and I'm going right alongside the executives who had confidence in their company the whole time. This is something that we've done, that I have done with Energy Transfer. Forgive me, I say we because I talk about Republic Research, my old company, a lot. That said, it's very, very important for us to just take a step back, you and I, and analyze these companies. And when I see these types of purchases, it gives me confidence, and that's one of the first places I want to start when I'm investigating. Now, I promised you some additional watch lists, right? So this, again, is the F and Z and 20 list. And at this moment, there's not a lot going on here. The companies with high F scores, which is that Piotrowski-Graham score that we absolutely love because it shows exactly that companies are doing the things that they should be doing to enhance shareholder value. The Graham score is that low figure, that figure where Graham is willing to pay up to a specific price. Very low. And then we're looking for reversion. We're looking for the stocks to break above their 20-day. The reality is that when we are in this environment, it's going to be very, very difficult to see breakouts virtually across the board. So we kind of have to slow that down, and we have to shake our idea out and say, okay, what does this specific environment tell us? May see squeezes, may see opportunity. We might have to go from the extreme value side to the extreme trash heap. What I mean by that is the companies that have the highest short interest in the entire market. Highshortinterest.com is a website that follows just that. These are the companies on the market right now, all Amex and NYSE, NASDAQ. What does it mean to have short interest, right? What does it mean to have high short interest? Well, what happens in this environment, because the markets are so fun, if you've seen the television show Billions, if you've listened to Dick Fuld complain that the shorts are killing his company as Lehman Brothers collapsed in 2008, short interest effectively refers to the amount of people who do something called shorting, right? If you've heard the movie The Big Short, this is exactly what it consists of. So I do not like the company. Let's pick one out of the sky. Oh, gee, let's just pick a garbage airline. How about American Airlines? All right, American Airlines is a garbage airline. Sorry, I'm ripping off John Mulaney. Okay, American Airlines. American Airlines, I think the stock may be overvalued. Let's say that I believe that the company is going to go bankrupt. I mean, who knows? Let's just say I don't like AAL. And I don't like AAL. I only fly Delta because it is the best. Okay. So back here in February, hypothetically, let's just say I look at this chart and I say, you know what? This stock is breaking under its 20-day moving average at $17. I would love to short this company. And let's pick somebody out of a hat. Let's just say Brent. Brent in the chat. Let's say Brent loves American Airlines. And let's just say that Brent runs an ETF. He just keeps American Airlines in his portfolio because he believes in it the long term. Now, he's willing to weather the storm, regardless of what's transpiring in this environment, because he's going to be long the company no matter what. He's going to hold the shares. And he might even have so many shares that he is a person who has access to the boardroom. So I'm going to borrow those shares from Brent. And he's going to say, yeah, you can take my shares. Just hold on to them for a while. What are you going to do with them? I'm going to say, I'm going to short them. He's going to say, okay, you're going to pay me 3.5% a month, a fee. Sometimes that fee can be very, very high. But let's just say he says, I want 3.5% a month. You're going to borrow my shares. I will then take his shares at $17 and I will sell them into the market. I will sell them into the market. And my hope is that the stock tanks, because if the stock falls from $17.70 down to $10, I can then buy the stock back and then I can hand them right back to Brent. And I could say, thanks, Brent. Here's your stocks back. Yeah, it's back down at 10. And Brent's going to say, I don't care. I'm long anyway. Thanks for your 3.5% to 6% over the last couple of weeks. And that will be on our way. So I will have made the difference between where I sold the stock at 17 to where I bought it back at 1080, right? That is just what shorting is. And it creates pressure in the market on two sides. One, it creates that selling pressure, which leads to swings in the stock, but it also creates buying pressure because let's just say that it went wrong for me. Let's say that I was trying to short Brent's stock back at 10 and I said, all right, stock just broke. Let's say it was August. Stock broke under 10. I'm going to, under the 20-day, I'm going to try to short this stock. And then I borrow it from Brent and I short it and, you know, it falls to 9. And then I go on vacation and then I wake up one day and the stock's at 14. Well, I have to buy it back. I sold it at 10. I have to buy it back at 14. So I've lost $4, right? My entry is 10. My net is now 6. I've gotten crushed and I still got to return it to Brent. But there are other situations where people will borrow a stock and then re-lend it to somebody else. That's what creates the fun where all of a sudden you see the short interest go over 100%. And that's exactly what happened a couple of years ago with GameStop, where shares were outstanding, were then re-lent to somebody else. And now all of a sudden Somebody had to cover, other people had to cover. We had to go out and find other places where I could find a stock. Maybe that person was still holding it, didn't want to give it back to, and it just created this web. And then all of a sudden, GameStop, which is a company that I'm stunned is still in business, stock goes through the roof. Well, right now, after all I said all of that, 43% of stock, 45% of all Beyond Meat, which by the way, you are going to learn is my least favorite company in the S&P 500, actually ever. Beyond Meat, 45% of the stock is being shorted right now. Okay? 45% is being shorted right now. It is 334. Now, if we take a step back, go all the way back to COVID, I mean, this is a stock that was, I think, at over 100. What were we? 157, and maybe that's a pre-split number. But this was a darling of COVID. Now the stock's getting killed. Here's the thing. When you combine our momentum indicator that we have, and this goes positive, these stocks can quickly end up in a squeeze. Or if they're being heavily shorted heading into the Fed meeting, and people start to cover their positions and it creates buying pressure, these stocks can squeeze up. And even though they are absolutely bad companies, right, with horrible profit margins and horrible operating margins and a horrible ROI, and they're well under their 50-day moving average, and they're probably going to go out of business unless somebody takes them public and saves them from themselves, pay very close attention because the MACD is turning positive, and if the MFI and the RSI squeeze up above 50, I might be buying this stock and holding it and trading it into Wednesday. And one last thing, because I got to wrap it up. The one last part that I want to focus on, and we're going to be here today live at, I believe, 12:30, but I have to check the schedule again because Don's still on the West Coast, and I can't figure out the difference between East Coast and West Coast with one bloodshot eye at 9:30 in the morning. I will figure this out. TradingView, one of the things that we do focus on here, and we're going to walk people through it, is the other watch list that we have. And these are the companies right here. AU, which has been ripping higher because of gold. Centerpoint, Rocket Companies, RKT. These are companies that are all crossing over positive MACD, positive RSI, positive MFI, positive ADX. These are potential breakout stocks. Well, whether they're the breakout stock or Beyond Meat is a breakout stock today, what we will be watching once again is what happens if these stocks get down into the third standard deviation. And as you could see yesterday, Beyond Meat broke down, falls into the third standard deviation of price, VWAP, and goes from 318 to finish the day at 335. That doesn't seem like a lot of money, 17 cents on a $3.20 stock. Well, it's a 5% move, but if you're trading on Friday, one of the beautiful things about Friday is that it's options. Options expire today. So there's no time decay left. You're operating just on pure price, and you can use effectively the leverage of options that are expiring today. And instead of paying $350 for 100 shares, you might be able to trade something that's out of the money for pennies. I mean, this is the type of environment that we operate in. So if something is way down and we're looking for a possible reversion, we can make a very small bet and it can turn into a very significant outcome just by reverting on the day. So we're going to talk about this today. We're going to look for those opportunities. And I know that I'm kind of pushing everything through a garden hose at you right now, but again, I really appreciate everybody coming in here and being a part of this. We're going to continue to build this up. I just want you to get used to the terminology, and we're going to continue to move from there. I will be back next week. I'm going to be in Hunter, New York, going to Cooperstown next week. I will be operating from there. We will have all the equipment set up, different background, but I will see you then. Everyone else, I will see you in the paid room today, I believe at 12:30, but just check the schedule.